Common shares and preferred shares have different features which make them suitable for investors with different requirements. While both represent ownership of a company, there are some differences between the two. In this video, I will tell you what common shares and preferred shares are and how they are different. Hi everyone, I am Prarthana from Clear. We are India's largest tax and financial services platform where we have served more than 6 million tax filers. Subscribe to our channel to get investing tips and learn more about growing your money. When investors talk about shares, they always refer to common shares. The returns of common shares tend to outperform the returns of types of shares over time. It is a result of the company doing well through increasing its profitability in the long term. The main aim behind buying common shares is voting power, which investors think is vital in the process of a company doing financially well. Common shares investors believe that a company may take negative decisions that protect their interests rather than catering to the company's performance. Hence, they buy common shares to elect the board of directors and have voting powers to have a say in the internal decision making. Did you know the first common share stock ever issued was by the Dutch East India Company in 1602? Preferred shares are traded less as their availability is limited. However, investors choose preferred shares over common shares because of the priority claim factor that affects the investor in two ways. First, if the company announces a dividend, preferred shareholders are paid first. Secondly, if the company goes bankrupt, preferred shares can claim the company asset according to their ownership in the company before other types of shareholders. Did the definitions make sense so far? If it did, please write clear in the comment section below. Let us discuss an example of a preferred share to give you a better understanding. Here I am going to tell you about Snapchat IPO, a highly anticipated initial public offering that consisted of no vote common shares was the IPO of Snap Inc. in 2017. While structuring common shares with different voting rights is common practices for IPOs, the no-vote common shares were a rarity and met with much criticism. The majority of shareholders were not given voting rights in Snap's IPO, which was controversial since key decisions were basically entirely up to the management under the proposed corporate governance plan.
Class A shares traded on the NYSE with no voting rights. Class B shares for early investors and executives of the company get one vote each. Class C shares held only by Snap's two co-founders, CEO Evan Spiegel and CTO Bobby Murphy. Each Class C share would come with 10 votes apiece and the two holders would have a combined 88.5% of Snap's total voting power post-IPO. So let us look at the difference between common shares versus preferred shares. Firstly, upside potential. Regarding common shares, the upside potential is almost unlimited as the market determines them. On the other hand, the upside potential for preferred shares is the maximum limit present redemption on par value. Upside potential is the increased value for investment as measured in terms of money or percentage. Secondly, downside risk. The common shares can fall to zero, but preferred shares may or may not fall to zero as they are less volatile. The downside risk estimates a security's potential loss in value if market conditions precipitate a decline in that security's price. Thirdly, share price volatility. Since the market decides the price of the common shares, they are highly volatile. Preferred shares are listed on exchanges and the redemption price and date are predetermined, making them less volatile. Fourthly, investment target. Both classes can be found on major exchanges, but the better choice depends on who you are, fundraising company or investor, institutional or retail investor, and your investment target, short-term or long-term returns. As names suggest, common shares are the more common and preferred shares have the preference over residual assets in liquidation and for dividends before common share. Fifth, allotment. The common practice is that startup founders allot common shares. They usually earmark a portion of the total common share to give to employees, an advisor, or create an option pool. The advisors in this context are those who help startups with strategic advisory and outsourcing of finance, HR, legal, and regulatory functions in various stages. Sixth, voting rights. One of the main differences common share and preferred share provide is that it gives its shareholders voting rights, while preference share does not.
Understanding the difference between a common share and a preferred share is essential to know which type of shares to buy. Investors who want a regular income should choose preferred shares. Since preferred shareholders get dividend payment on a priority, it gives them the confidence that they will receive regular dividend payments. But in doing so, they lose the potential of earning uncapped profits that common shares may provide. If you are looking for potentially high returns, common shares are for you. It is important to note that investment in common shares also comes with a high amount of risk since you can lose all your money. So you should invest in common shares based on your risk appetite. So folks, I hope you understood the difference between common shares and preferred shares. You can start your investment journey by downloading the Black app by ClearTax from the link given in the description box below. Download the Black app as it will help you grow your wealth and invest wisely. Also, don't forget to subscribe to our channel for more finance related content. See you soon in the next video. Goodbye.